Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host Surabhi Upadhyay. Now, India's retail investors are all set to get a brand new asset class to invest in. This new product will be a bit more sophisticated perhaps than regular mutual funds, but hopefully not as complicated as PMS or AIF products. I'm talking about an asset class that will be known as the Specialized Investment Funds, an asset class that will look to bridge the gap between mutual funds and products like PMS, which is Portfolio Management Services, or AIFs, which are alternate investment funds. Now, we have to discuss what the risks are, what are the tax implications, what are these new, more sophisticated strategies involved, and should we investors really care? Well, to do this, I have two very special guests with me in the studio, Radhika Gupta, MD and CEO of Edelweiss AMC, and Swarup Mohanty, Vice Chairman and CEO of Mirae Asset Managers. Thank you so much, Radhika and Swarup, for joining in. It's a pleasure to have both of you in person with me in the studios. And with your presence together, I know this is an exciting moment for investors. What are we looking at? Lady, let's start with you.
Thank you. It's lovely to be here. I think, I usually have more mixed opinions about new things that are launched. But with the SIF launch, I am reasonably bullish. You said it's a middle path between MF and PMS and AIF. I actually think that for the consumer, it brings the best of both worlds. What and I came from an alts background, so perhaps this is closer to heart, but I think what PMS and AIF offered is flexibility in investments, flexibility in subscription redemption, how you use credit, how you use derivative. But what mutual fund offered was comfort. People are comfortable with the structure. You can do SIPs, huge sense of tax advantage. The consumer doesn't pay any tax. I think SIF gives you the flexibility that that AIF and PMS had, with all the comfort that mutual funds have. And the 10 lakh ticket size, I really think, opens this up to consumers, a much wider range of consumers, because when you were talking AIF, you were talking 1 crore investor, which means someone with 10 crore net worth to hoga, because you won't put more than 10%. So that versus someone with a 1 crore net worth, I think the ambit of people that we can speak to is very good. So I think in India's asset management evolution, you saw the evolution of passives, multiple investment styles, smart beta. I think this is a welcome step in the evolution, and I'm glad the mutual fund platform has been chosen, because it's a platform people have gotten comfortable with.
Okay. Well, the objective is to make it as simple as possible for people to understand, because there are nuts and bolts and nuances of this new product. Swarup, what are your opening thoughts? Do you see this as a big stepping stone, or well, it'll be one more product that AMCs offer?
No, it's a step forward, both for the investor as well as the asset manager. I mean, look at it, we are graduating forward into a slightly more evolved space. I won't say complicated or easy space, but for an asset manager, it's great to start expressing ourselves into new areas of investments. The regulations have made it far more broader than what we used to do. The risks are very different, so how we manage it, how we look at the whole space will be different to each fund managers. And I think it's the emergence of style-based investing coming out from each fund houses. So it's a great platform to express our backend to the investors. At the same time, from the investors' perspective, and I say this with all humility, when I look at the last 2-3 years in particular, when return chasing has become so blatant, risk understanding needs to go up. Finally, you start your investment journey thinking it's a process of return generation, but it's a process of risk mitigation. I think this will set the tone for people to understand risks more, and the safer or the better approach to risk will be a better approach to investing. So it's a great step forward, and I echo what Radhika says, and it's fantastic that mutual funds were considered to be this vehicle for the future.
To offer this new product. So I think the first checkpoint, I think we've all taken note of, that you need to have a minimum investment threshold of 10 lakh rupees, which is not too much if you're looking at the mass affluent, households of India. Most of us are investing, that amount or maybe higher across mutual fund schemes. But let's understand the nuts and bolts of this product. So what the original understanding was that this product, the SIF, will have more flexibility in terms of taking long short strategies, more derivative positions, something known as naked shorting in the market. Radhika, if you could just expand on this, what are some of the basic differences, say, or in architecture perhaps, between regular MFs and this new product?
So I think there are three differences that consumers should know about. One is derivatives. Now, mutual funds were allowed to use derivatives. It's a myth that they were not. Arbitrage funds use derivatives, balanced advantage funds use derivatives, but they use derivatives for the purpose of hedging. They don't use the derivatives for the purpose of expressing a view. So if I was long stock A by 50 rupees, I had to be short stock A by 50 rupees in absolute amount. Now I can be short stock B by 10 rupees up to the tune of 25%. So in that sense, I'm allowed to express a negative view or use derivatives beyond the purpose of hedging. So that I think is the number one flexibility. So suddenly, you know, if you look at the SIF categories, you take a category which was a normal flexi cap category, but you are allowed to apply derivatives. You take a category, they've got one called X top 100 long short. It's like a mid and small category of the old mutual fund, but suddenly I can express a view that is negative.
And this is capped at 25%,
25%.
right? The total short position, so to speak.
Is capped at 25%.
Okay.
So that's one. The second flexibility is around exposure to credit. Now, most of the conversation around SIF has centered around equity, long, short, etc., which is okay. But there are substantially larger relaxations for credit, which is a good thing. And maybe you will see the revival of credit funds post 2018 in some format. We saw the private credit industry grow in a big way. The third, which is related to both of these, is that mutual funds are daily subscription and redemption instruments. Here, depending on the category, you don't have to provide daily redemption. The asset manager can choose to provide bi-weekly redemption, or in the case of a fixed income fund, weekly redemption. So many of the issues of the old of having illiquid credit but having daily liquidity perhaps can be mitigated more sensibly.
To simplify this, what it means for me, the investor, is that there could be products which don't allow me to redeem on a daily basis. It could be perhaps once a week or once a fortnight.
And which is why it's very important in SIF, and we can talk about this more, to read the risks and understand the fine print, because it will not be the same.
No, absolutely. In fact, we should try and flash that. I have that disclaimer that the regulator has also put out. I'll read this out since we're just starting the conversation. Here's what SEBI is saying, and this is a mandatory disclosure that will go with all of these new funds. Investments in specialized investment funds involve relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all the investment strategy related documents carefully before making the investment decisions. I've taken more than 30 seconds to say it for sure. So, Swarup, come in on this. I mean, and expand on some of these points, that there are more sophisticated strategies, some of the derivative strategies that Radhika alluded to. From an investor's perspective, I'll say, क्यों करना है? If I'm getting more return, तो ठीक है. Otherwise, why do it?
See, at this moment, forget SIFs. If somebody is not investing, it's that person's problem. It's probably the best phase of the country, and the best way to get that growth of the country into a person's portfolio is probably the capital markets, right? And this offers a far evolved position, like I've been using the word evolved, for the investor. Now, a lot of investors have different risk profiles, right? And this is a product which is catering to a slightly evolved, somebody who's been investing for 20, 25 years in mutual funds for that, can look at these in a far graded manner than they used to. Now, here's the thing. Now, suppose the flexibility is for 25%. We need not go 25%. Now, suppose the option is to go 12% in lower credit rating papers. We need not go 12%. Each fund will have its own way of expressing that same risk profile to the investor. And hence, the need for the investor to read a little bit more about this is very important at the beginning of this journey. And once that, and it's not rocket science to understand all this, okay? Guys like me will come and pose that it's a rocket science vehicle to make ourselves more important, but just a little bit of reading can ease out a lot of things. What can happen through these products will be far more evolved than what we've put on place in mutual funds is a submission.
So derivatives is one important aspect that Radhika touched upon. I believe that there is a greater exposure that these funds can take in REITs as well. For instance, REITs, in REITs. Anything you want to add?
All those exposures have doubled. I mean, 20% we can go up to.
Okay.
And that's why the flexibility on redemptions.
Yes.
Some of the underlying assets need not be as liquid as we have to take on the mutual fund side, because we have to give redemptions on a daily basis. And that gives the difference of flexibility to the fund management. One can dig deeper into these papers and hence aspire to give a higher yield, right? And that's where the maturity of the product comes in, and it's up to the investor to understand why the need for periodical redemptions. It's for the betterment of the investor. See, in any portfolio, there are three types of investors. The investor who's coming in, the investor who is there, and the investor who is leaving. The fund manager has to be fair to all three at all point of time. Now, if the product is at the underlying is a little bit illiquid, then the person should be able to sell it, realize that value for the person who is going out, and also for the essence of investors who stay back.
We're staying back.
So all these have been thought through, and what has come out is a far suitable product for the underlying product, for the portfolio from an investor's perspective.
Okay, I want to quickly go over the categories, the strategies that the regulator is allowing. Like that for mutual funds, there could be one large cap fund, one mid cap, one small cap. So regulators very clearly defined what kind of funds can be launched by AMCs on the mutual fund side. Similarly, now they're talking about very specific strategies that can be launched within an SIF. So let's start. So equity oriented strategies, debt oriented strategies, and hybrid strategies, similar to mutual funds. So Radhika, let's start with the equity oriented strategies. What are we talking about here?
So I would just break this if you just look at mutual fund parlance to simplify. They have equity.
Yeah.
Now they have three categories. They have an equivalent, or they have something called equity long short. What is that to me? That is a flexi cap fund in the mutual fund world with additional flexibility around derivatives.
Okay.
You can go everywhere, but you can also use derivatives.
Okay.
Then they have a category called X Top 100.
X Top 100 long short.
Long short. Now again, that is your mid and small cap. You used to have, we have mid cap and small cap. We used to have a mid and small cap category in mutual fund. We used to run one fund. That's mid and small cap. So you buy beyond the top 100, but you have the flexibility to short. I want to add one point to what Swarup said. Just because you have 25% flexibility to short doesn't mean you're always 25% short.
Right.
You could like a stock for the long term, for instance, in the mid cap space, but have a negative view for a month because there's an event going on, and then take a short position on it. So it's not mandatory short, it's flexibility to short. So that's your second.
Right.
And there's a sector rotation category, which in my view is like a business cycles category of the old. But there you were expressing views, you were taking very concentrated bets on sectors. Here you can take negative bets. So I can be long financials, short technology. So that's your equity category in a sense. It's your old flexi cap, mid and small cap, and business cycles with the layer of shorting.
With the layer of shorting and the new nomenclature. Got that. There are debt oriented strategies as well. There's a debt long short, and there is a sectoral long short fund as well. So do you want to sort of explain that a little
again,
bit?
same analogy. The debt long short is like your old dynamic bond fund, but you can use interest rate future. Flexible in debt in terms of where it can go in terms of credit and duration.
Also interest rate futures. It can,
You
there
can use
be a play
interest
on
rate
that.
futures there. So it's dynamic bond fund with shorting. That's shown up. And then the second one is your sectoral. I think that will probably be used for credit kind of funds because you can do financial services. So all your HFCs and BFCs, etc., kind of exposure can come out. So again, dynamic bond fund and credit fund with shorting.
Oh, okay. All right. So
and liquidity.
Okay. So those would be some of the debt strategies. Then in this SIF, there are also hybrid strategies, which the regulator is allowing. There is an active asset allocator long short fund and a hybrid long short fund. Now, these products will evolve as we go, but Swarup, I mean, broad thoughts on how they could look like, what they could be like?
Like you said, I mean, early days, and the beauty of this product is, every fund house can express the same category very differently. Unlike, in the mutual fund side where the categorization has defined a lot of it, and ideation is somewhere taking a back step, and that's the beauty of this side. Radhika can take a completely different view of the same category than what we can take. Right, and both can be right.
25% short on that particular one sector and that sector fund. You could be long on it.
Yes, absolutely, and that is why I said it is evolving of the entire environment, and that's why we all have to go for a re-examination, passing thing of the whole thing. The environment will be reassessed. All of us have to go through
and a new name,
everything. And you see, when you look at the new name, it's very important that it's been given a completely new perspective with our parent not being, we can carry, say, Platinum by Mirae Asset, but Platinum has to evolve.
Well, which is very important. Let's tell that to our viewers as well, that we have two of these SIF identities that have been launched so far in the market. The one that Mirae has put out, as Swarup is saying, is called Platinum SIF, and the one that Edelweiss has put out is called Altiva SIF, right?
Yes.
Individual identities.
Individual identities.
And that's how these funds are going to be.
No, but I think it's important to have the individual identity because mutual fund, especially with Sahi Hai and everything, and I'm sure Swarup agrees, has a connotation that it's very simple, it's very standardized. So, with due respect, a Mirae mid cap and Edelweiss mid cap There is not that
It's
much
the same
difference in what we
playground.
do.
You play in the
It's
same
the
250
playground.
stocks or- yeah,
and I
yeah,
know
yeah.
I'm going to get my money back in one day. There's that
Yeah,
promise.
yeah,
So with
yeah.
SIF, I think for the consumer and the distributor, the challenge is the nuance will be a lot more. He's been
Absolutely,
saying evolved, I'm
absolutely.
saying nuance.
Yeah,
But
yeah.
you can't just rank sort to, X top 100
Absolutely.
funds.
Yeah,
You really have to look deep.
Absolutely. And I really hope that viewers are listening, because viewers, if you want to be in these sophisticated products, you have to do more homework for sure and ask more questions. And we'll continue with our questions after a very quick break, because we need to understand taxation and also general sense of return profile when we're looking at these new SIFs. Back in just a moment after the break.
Let's talk money.
Welcome back. Well, we're in the midst of a very, very interesting conversation on a brand new product that's about to hit the market for all of us retail investors. It's the Specialized Investment Fund, the SIF as it's being called, and AMCs are in the process of launching this out. Remember, minimum threshold is 10 lakhs. The strategies are a little more sophisticated than ordinary mutual funds, but then can the returns be enough to sort of, justify that higher risk? That's what we're discussing. As I was thinking about our conversation in the previous segment, Radhika and Swarup, it seems very important to me that the knowledge building around this product is going to be critical, because these are sophisticated strategies. And let's face it, when we're looking at investments, 90% of the conversation with our advisor or distributor is focused on return. Milega kitna? So how will, this will have to be dealt with differently, won't it, Radhika?
It needs nuance. I've been saying that again and again. And, we as a brand under Altiva are spending a lot of time and effort in consumer training and in distribution training. I know distribution has to pass a certain set of exams, and many of them already are, but we are spending the effort on doing that. The greatest tragedy would be if SIF is seen as which PMS was, as a route to, I will get higher return.
Yeah.
Actually, SIF is not about that. What's the flexibility you've been accorded in the equity side? It's derivatives. Derivatives may be used to give better risk-adjusted returns. So, if in an arbitrage fund, in mutual fund, I was getting X return, maybe I can use some more sophisticated strategies to get arbitrage plus. Maybe I can get an equity-like return with lower drawdown than equity. But these are nuanced conversations.
Yeah.
And we've moved to a world, as I said, where we have this sorting investor. You go to a website and you sort which is rank 1 fund.
Past 3-year return.
No, past 1 year return.
Or past
Trust us,
1 year
we know. And I'm saying that is not healthy in mutual funds because all of us have different styles. It's even more unhealthy in SIF because we talked about equity long short. He could run a fund with 45% net equity exposure, and I could run a fund with 0% net equity exposure. He may obviously have a higher return, but are the risks comparable? So the conversation has to be about risk-adjusted return.
So, Swarup, how will the investor navigate this? And, isn't there, I don't want to be negative, but isn't there a very clear risk of mis-selling as well if the distributor doesn't explain all of this nuance and the risks that Radhika is speaking of?
I say that the beauty is we are at the beginning of the whole thing, and a lot of that responsibility lies on us AMCs to form partners who will go out and propagate the risk. I mean, while we were discussing this, I was reflecting on myself as a salesperson. When I started my career, I was very afraid of talking about risks. But as I became more open about talking about risks, I developed better partnerships and better investors. And hence they stay with us longer, as simple as that. Till we are not afraid or think that risk is a bad thing, risk is actually the best thing that we can talk about. The more the customer understands, the bigger the wallet share will be. And so at the beginning, I think a lot of that responsibility lies with us. And like Radhika said, I think all of us will put our efforts to educate people. And more important, I think it's also to tie up with people who will understand and propagate it in the right manner. That responsibility lies with us, I think.
So now let me ask you, what do you think will the sales pitch be? I'm sure your teams are already working on this. And when we talk about risk-adjusted return, see, the mutual fund investor over the years is very clearly understood. Stay in equity funds, and I'm talking only equity right now. Stay invested 5, 6, 7-year period. 12 to 14%, maybe in good years, 15%, basically 12, 13% compounded CAGR. We've, come to understand this and internalize it. Explains how SIPs are still steady in volatile markets as well. So what is the pitch going to be to the SIF investor now? What should be a realistic risk-adjusted return to watch out for?
See, finally, there is a pyramid of the investor breakup. I mean, at the bottom is participation. where you come in and buy the market, right? Above that, you come into a mutual fund category, which is broadly I can say on the verge of being a commoditized product because it's very similar to each other. Above that, you come for these pretty specialized and very skill kind of products, which PMS AIF were reached to a certain extent, and we now come into that entire picture. An investor has to choose where he or she wants to be, right? And it's that mitigation of risk which defines a better investor.
See, but Swarup is not talking about the risk-adjusted
But
I'm coming
average
to that.
return expectation.
See, there is
I
this
think he's
cliched.
right. He should not talk about
There is
it.
that cliched statement that higher the risk, higher the return.
Yeah.
The statement should be higher the risk, higher should be the return.
Absolutely.
Now,
Yeah,
in these
absolutely.
three parameters, if the risk-adjusted return is not higher, then why should the investor
go for
come?
it? Yeah.
It's up to us to come and say that because you are taking this additional risk, hence the chances of this return being higher are there. And that's something which we have to demonstrate. Right now, it's not right to talk because we have to demonstrate it and build track record. I'm sure the talent of the industry is such, and we are coming to it after 20, 25 years of doing that same business. But now, since we have the flexibility, maybe my initial thought is a lot of us will approach it with a little bit of caution, but then the fund managers will be free to express themselves.
Yeah,
And trust
yeah,
me,
yeah.
the same manager will express himself or herself far broader than what we used to. So when this product unfolds and the communication becomes clear, clearly the need for a person to go up the risk ladder will also be justified is the simple point I'm making.
Almost running out of time, but Radhika, very quickly on this point of return expectations, and I'm saying compounding, 5 years if someone is in this product, it would be fair to expect, I don't know, maybe at least more than 13-14%, because MFs are giving you 12-13%,
So
right?
here's where I disagree, and I'm glad Swarup didn't answer the question, because when the question is asked in a normal mutual fund, what is your return expectation? Kitna return dega? This is India. I go crazy because I'm like, kaun sa mutual fund? Mutual fund can be small cap fund and it can also be equity savings fund. And expectations are very different. Now, mutual fund has a wide variety of categories. SIF is so much wider. So
The equity SIFs, let's
I'm
say.
telling you, in an equity SIF, which has 80% equity exposure versus an equity SIF that's long short and has 20% exposure, the return will be very different. So at least our intent with this is, under Altiba, one, we're not going to rush to fill all 7 categories in one go. This is not NFO central. Each category, in my view, requires very different capabilities. It's not like you have a consumption fund and a healthcare fund and an IT fund and mid and small. Each category is a different capability. We'll launch a category, educate on the so if we're launching something in the hybrid category, we'll educate on the nuances of that category. What's the right time horizon? What's the risk you're taking? What's the return you could get compared to a traditional instrument? What could go wrong? And we'll do that for a while.
Okay. Out of time, I realize we need many more classrooms. The journey has only begun, right?
Yes.
But in 10 seconds, broadly, taxation is similar to what we have in mutual funds, right?
It's
As
a
of
mutual
now.
fund product.
It's a mutual fund product with a new set of rules.
New set
or
of rules,
different
okay.
category of mutual
Correct,
funds.
Okay, fantastic. I think this is a great starting point, and thank you very much, because now we have some, opening thoughts and understanding of what this new, lovely little animal is going to look like, and how it evolves is something that we have to watch out for. Thanks very much, and this is already an open invite for a round 2, maybe a couple of weeks down the line,
Anytime.
when some of these strategies start coming to market, and that's when we really need to pay attention and understand what they are and whether they suit our risk profile or not. Thanks very much, Radhika and Swarup, for joining in. Promises to be, the first of many, many conversations on specialized investment funds. Well, viewers, with that, we have to take your leave. Do keep sending us your feedback, comments, and queries. See you again next week.
Let's talk money